these are a list of things which I personally analyze while investing in any company before investing in any company. I repeat, investing, right? So first of all comes layman mindset. So we are surrounded by companies. For example, right now, wherever you're sitting, just look around for once. You'll look up, you'll see a fan. Fan is of a company. So my fan is of Havells, right? My AC is of Hitachi, right? My watch, my phone, everything around happens to be of a company, and behind majority companies there is a stock. So for example, you want to invest in, let's say, Bata. So Bata shoes, Bata. So you'll just have a basic mindset that, okay, Bata company, I've been hearing since like childhood. I've seen Bata ads as well. I've visited Bata stores as well. The company has been doing good and it has been consistent over the years. I am happy with Bata products. My parents are happy. My friends are also wearing Bata shoes. So that is doing a layman mindset analysis, that what do you exactly know about the company before deep diving into the technicals and the books and everything. And one of the greatest investors, let me tell you, Peter Lynch, he's my favorite investor. So he's the God investor according to me. So even he has mentioned in his books that one of the best investments that he did was by just looking around. For example, he mentioned an example. So during 1970s or 80s, his daughter was like, after his life, Dad, I want to buy new jeans. And that there was this company called Gap, GAP Gap, of American company, that was very famous and everyone was buying the jeans of Gap. So his daughter just pulled him towards Gap showroom, right? And then and there, while his daughter was shopping, he just looked around the business. He saw that people are going crazy over this brand. This brand has been expanding everywhere, and this business looks good. He just went back to his office. He saw the basic books, balance sheet, and the business and everything, and he invested his money there. And it became one of his best investments ever. So that's how simple investing is. Industry analysis, right? What is industry analysis? So every company happens to be a part of an industry. So for example, Airtel and Vodafone Idea are from telecom industry. Bata, Nike, Reebok, they are from footwear industry. Tata Motors, Maruti Suzuki, automobile industry. So if you're investing in any company, you should also see what type of industry it is. You wouldn't want to invest in any industry which does not have a future. So for example, stationery is one industry which I believe, I might be wrong, I don't believe that after 10 years or 20 years, people would still want to buy physical books and read them and spend so much money on them when ebooks are available. While at the same time, an industry like IT industry, that's bound to boom. That's like the future, because technology is taking over the world, robotics, automation, artificial intelligence. You do a basic industry analysis, like what exactly is the future of that industry. Third point is company versus peers, right? So every company is in an industry. So every company has competitors, right? So Tata Motors, a competitor is Maruti Suzuki, Hyundai, Honda. So always when you are investing in any company, just look into it peers. So for example, HUL, Hindustan Unilever, is a FMCG company. Like it makes products for us, like shampoo, tea, coffee, and all that, right? So you'll obviously want to look into its competitors. That is Dabur, that is Imami, that is Patanjali, right? Because they are also making similar products. So never invest in any company without looking at its competitors, because you never know that its competitors are doing better and have a better scope than it, right? So you might want to invest in them and not that particular company. And then comes the fourth point is qualitative analysis, right? So what is qualitative analysis? So qualitative analysis, as the name suggests, it's about analyzing the quality of the company, or like the business you're investing in. So for example, you are investing in Tata Motors, so you would want to know who is the owner of Tata Motors, what exactly is the management, who is the CEO, who is the COO, what are their exactly qualifications, what are their outlook. So every time, every year or every quarter, the management of every company happens to have meetings, right? The general meetings, the company meetings, and they are some comments that they make. They tell people the outlook for the coming years and coming months, right? So you have to just see, you just read basic, it's all public information. You just need to have the particular apps, like Money Control is a very good app, Economic Times, Mint, all these apps show you this brilliant information. So you just go on them and read what exactly the company is saying. So if you think that company is being optimistic, it is saying that if they are expanding business, so then you obviously would want to invest in that company or stay invested. So that's about qualitative analysis. So now comes the main analysis, which are these last 5 points: P&L account, balance sheet, cash flow, shareholding pattern, and financial ratios. Now, this might be totally new to a lot of people here. In profit and loss account, I see basic three things. That is sales, because sales are the most important things. Even if the company is not making profit, if the sales are increasing, that means the company is trying its best and expanding its business, right? Sales is very important. Next comes a net profit. You have to obviously see if the company is making profit or not, because if the company is constantly losing out money and the loss is increasing, then you might not want to stay in that company, because it might get bankrupt someday, it might just shut down someday, right? So you all obviously have to analyze net profit. And then comes dividend. So many of you might ask, what is dividend? So for example, I am a company, I earned 100 rupees this year, right? So now I have three options of what to do with that 100 rupees. I can either expand my business and invest full 100 rupees into my business. That is called reinvesting your profits. Or I can pay off my liabilities. If I have any loan, I might pay off my liabilities. So that is another option. And the third option is giving my shareholders, the people who hold my companies, you and I and the management, some part of the profits as an appreciation or just a reward of investing in that company. So that reward is called dividend. So every time a company announces a dividend, all the shareholders are given a part of it, like whatever profit the company earns divided by the number of shareholders or the number of stocks, it is get credited to your bank account. So for example, a company announces a 10 rupees dividend per share. So if I'm having 100 stocks or 100 shares of that company, I'll get 1,000 rupees in my bank account on a given date which they announce. So that these three things which I analyze in profit and loss statement, you might take a screenshot or click a picture or write whatever it's feasible for you. It's just very basic. Then comes balance sheet. In balance sheet, I see reserves, borrowings, and assets. Now, what are reserves? So reserves are like just what our parents do. You save money for a rainy day. So in case any emergency is there, in case there's any marriage in the house, you need to have some, excess money, right? Similarly, a company also have reserves for any future prospects, for any future events, or probably in case of any emergency. So for example, COVID happened, so a lot of companies had to use their reserves in order to sustain in the market, in order to pay salaries to the employees, in order to not get out of the business. So reserves are very important. If a company is having a good amount of reserves, you can trust that company, because that this company won't just vanish out of thin air, right? And then comes borrowings. So it doesn't matter if you have tons of reserves, if you have a lot of borrowings, right? Because borrowings is not your money. You are taking it from another person, another entity, and you are also paying interest on that. So increasing borrowing is a very bad signal for any company, any stock, because come on, you'll have to repay it someday. But if you are increasing it instead of repaying it, it's not the best sign, right? So you have to see the borrowings. And if a company is not having borrowings, it is called a debt-free company. Those are the best companies to invest in. Honestly, it's not a hard and fast rule, but again, if the company is debt free, it's a very good signal, according to me, for sure. And then you see assets, what the company is owning, the land, the machines, the properties, everything. So if the assets have been increasing, it's a good sign, because the company is getting more and more value. Like for example, if you have 5 properties today and tomorrow you'll have 7 properties, so you'll get richer, right? Then only you'll have 7 properties. That means you are growing, you're financially, you are growing. So similarly, for a company, treat a company as a person. A company is a person, just treat it as that, and you'll just keep it very simple, and you'll be able to understand it better, right? So reserves, borrowing, and assets, that's what I see in a balance sheet. Coming to cash flow statement. So cash flow statement by default is divided into 3 parts: cash flow from operating activities, financing activities, and investing activities. Now, operating activities involve day-to-day activities, sales हो गई, like you might want to spend some money in stationery. For example, if you are having an office, you need to buy stationery, basic stationery. So that's the daily thing which happens. Is there any employee who wants some money? So that comes into operating activities. Paying salary and everything, that comes into operating activity. Now, what is financing activities? If you give a loan or took a loan, or if you bought some shares or sold some shares, that comes into financing activities. Very simple. And investing, it's all about buying a property, selling a property, buying a machine, selling a machine. That comes into investing activity, right? So these 3 things I see in a cash flow statement, and you might just be getting a bit intimidated that how exactly do I see them. I'll do a live analysis, just sit tight. Now come ratios. I see majorly three ratios out of 500 or 600 or 700 ratios. I just see three ratios to keep it very simple. And I believe these are the most important ratios that you should look into. First ratio is debt to equity ratio. So it basically gives you a picture how much is company, liable, like how much loans are there as compared to the companies, standing. The equity is all about companies. Like for example, equity involves the stocks which are flowing in the market. For example, I told you that 100 parts of a company. So as compared to that, what is the debt? So for example, there are 100 rupees share in the market and company is taking a loan of 200 rupees. So 200 upon 100, that comes 2. So debt to equity ratio comes out to be 2. So there are certain rules that, this particular number is a good debt to equity ratio and this is a bit much. So on the basis of that, you make an informed decision, right? So first I see debt to equity ratio. Second is price to earning ratio. Now this is one of the most important ratio according to me. And a lot of investors make decision on the basis of this single ratio. Price to earning ratio just compares the price of the stock. So for example, Airtel stock is right now around 620, 615 rupees, right? So price 615 divided by earnings. So what exactly is the company earning in the last year or the last quarter? You divide that. When you divide that, you'll get a number, and that shows if the company's share right now is overvalued or undervalued. If it is overvalued, you wouldn't want to invest in it. But if it's undervalued, it's a good opportunity to make some money, right? So price to earning ratio is one of the most important ratio. And there are certain numbers, there are certain ranges which people say that this is a good PE ratio. It's called PE ratio. This is not a good PE ratio and this is an okay PE ratio. So I'll let you know about that too.
So Raj, there's a question. What do you mean by overvalued or undervalued?
Sure. So for example, so any company, for example, my companies, everything, when you sell it, for example, if I shut down my business today, I pay off all my liabilities. I sell all the properties, all the lands, I pay off everything and just, shut my business. So whatever money I'll get, that is the net worth of my business, right? So for example, that net worth comes out to be 100 rupees, right? Okay. And now the share price per, so what exactly is a share price? So share price is, so for example, if a company is having 1,000 shares, right? And the company's value is 100 rupees. So 100 divided by 1,000 is the actual value of per share, right? So 100 divided by 1,000, that's 0.1 rupees. So the actual value of the net worth of the business right now is 0.1 rupees. That is fair value. That is the exact value. But if that particular share is trading for 0.5 rupees or 0.8 rupees, that is overvalued because actual value of that share is just 0.1 and it is trading at 0.5 or 0.8. So that means you're paying way more than the actual value of that company. So that is overvalued. And at the same time, if that share is trading at 0.05 rupees, for example, so it is undervalued. You're getting the business of 100 rupees in just 50 rupees in layman terms. So that is all about undervalue and overvalue. It's all about numbers, like fundamental analysis and investing. You have to play with certain numbers, and people who are not from a mathematical background, they just get intimidated. But honestly speaking, whatever we learned in 5th and 6th class, like the maths of 5th, 6th class, that is applied in stock market. Usse upar you don't need to learn and you don't need to know. So it doesn't matter from which background you are. I know a lot of doctors who are amazing investors, right? So I believe that answers my question, right? So next we see.
Raj, what makes a stock overvalued? Like, why would a stock be trading at a higher value than the company's value?
Sure. So for example, let me give you a very good example. Bharti Airtel stock. So today Airtel stock is trading at X rupees, just say X rupees. And now Airtel CEO, he comes out and he says that, hey, we are about to launch 5G services very soon in India. So it's a very good, very good for the business. People would be like, wow, Airtel is launching 5G, so the business is going to increase, the profits are going to increase, the customer base is going to increase. So let's invest money in that particular company. So because of a lot of demands, it's all about demand and supply. So demand will be heavy demand. So that X price will start trading in the market and people would be buying and buying and buying. So when there's excess demand, more the demand, the price goes up. We all know that, right? So that X will become 2X, 3X, 4X. So just on the basis of a single news, a stock price fluctuates very, very bad, right? So there are cases when the stock price exceeds the limit, the exceeds the actual price limit. And honestly speaking, like telling you from the practical experience, all the stocks in the market, majority stocks in the market are always overvalued, like always overvalued. If you just analyze a business and the stock price and you multiply the stock price with number of stocks floating, the variation would be like, you know, mind blowing. Honestly speaking, all the business are overvalued all the time. But again, then we'll analyze what that, how up to which extent are they overvalued, and we compare among companies. So I'll just compare Tata Motors, Maruti Suzuki, Ashok Leyland, and Hyundai. So I'll just see out of these four which one is the least overvalued. That's how you work in the real market. So that's why there are certain cases where the company doesn't want to be overvalued. Who wants to be overvalued? But the investors, you and I, our demand, the mutual funds demand, they make the stock overvalued, because, you know, every day in news there are some hot stocks. So hot stocks are the stocks which have announced some good news and everyone wants to be a part of it. That's why a stock becomes overvalued. That's how it is. And then there's a ratio called CAGR. CAGR, the full form is compounded annual growth rate. You just see that in the past 5 years or past 3 years or past 10 years, how much return it has given to investors, right? So obviously, if a stock has given you negative returns over the years, if to an investor, you wouldn't want to be invested in that stock. You'll be like, oh my God, that what's the sense? My 100 rupees got 90 or 80 or 70, or it has given me negative returns. I wouldn't want to be there. So CAGR should also be kept in mind, that what that stock has, how it has been performing, right? And then comes shareholding pattern. And there I do an overall analysis, which I'll just demonstrate to you in just a few seconds. And you can just read this quote. It's one of my favorite quote. Like, people who don't want invest in the stock market or any instrument except for FDs and bank accounts, it's for them. Right. So let's move ahead. And I believe now we'll be doing the practical thing.
I think we'll end the session here, but Raj, thank you so much. Totally amazing. I don't know how you managed to cover pretty much everything in 1.5 hours. I am blown away. I also personally invest and I use Zerodha, but you kind of covered everything so quickly and so thoroughly. I mean, pretty brilliant.